Bar charts are the classical way in which data has been represented graphically in the West. A bar chart is similar to a candlestick, however it is much less expressive. Like the Japanese candlesticks, bar charts are capable of conveying opening, closing, highest and lowest prices of a trade session. The next type of chart is a line chart. The line chart is the easiest way of graphically representing data. The line chart can display only one type of data, such as price. Usually, this is the closing price. The practical application of the line chart in technical analysis is very limited. This is why it's used for simple representations of trend development only. Now let's look at an equal volume chart. The equal volume chart was developed by Richard W. Arms with the purpose of the simultaneous representation of the price and volume. The volume is usually represented as a histogram in a separate chart displayed below the price. However, in an equal volume chart, the size of volume is relayed via the width of the bar. The greater the volume, the greater the width of the bar. The topmost point of the bar represents the highest price of the session, and the bottommost point, the lowest price. The volume is expressed as a percentage of the total volume of the shares traded during a given period of time. So, for example, if we want to create a chart for XYZ stock covering a period of 30 days, the total volume of shares traded during this period was 10 million, let's say. On the first day, the volume was 500,000 shares. The second day, 1 million. The third, 750,000, etc. On the equal volume chart, the width of the first bar will equal a conditional 5%. The second bar, 10%, twice as thick as the first. The third bar, 7.5%, or 1.5 times thicker than the first bar, etc. The next is the candle volume chart. The candle volume chart is an attempt to combine Japanese candlesticks with the equal volume chart. Such an approach allows for not only the representation of volume and prices on the same chart, but also takes advantage of the candlestick's ability to create patterns. The next type of chart is called a kagi. Kagi is another original Japanese system of graphical representation of prices. The kagi chart consists of interconnected vertical lines of different width and direction. The width and direction of the kagi lines depends on the behavior of prices. There are some simple rules to follow when creating a kagi chart. 1. If the change of the price coincides with the direction of the previous day, the vertical kagi line is continued. Rule 2. If the price movement reverses for a given value, called reversal amount, a new vertical line is started and connected to the previous one by a horizontal line. Rule 3. If the reverse price movement is less than the reversal amount, no lines are drawn. If the closing price exceeds the highest point of the previous kagi, the new line is drawn with a greater thickness. And the last rule, if the closing price is below the lowest point of the previous kagi, the new line is drawn thinner. Now, what does the kagi do for us? Well, it's believed that the kagi chart effectively reflects the levels of supply and demand. The thick lines indicate that the demand is greater than the supply, a characteristic of a bullish session. Conversely, the thin line indicates that the supply is greater than demand, which is a characteristic of a bearish session. There is a simple trading system based on the kagi chart. Open a long position when the thin lines change to a thick line. Open a short position when the thick lines change to thin ones. Further, the kagi can show us if there exists an overbought or oversold condition on the market. An overbought market means that the current market price levels exceed the expectation of analysts. An oversold market means that the current market price levels are much lower than the expectations of analysts. It's normally the case that when the market is overbought, one should expect a secondary reaction, or downtrend, when the Kage chart displays from 8 to 10 thick lines, each of which exceeds the previous one. Similarly, when the market is oversold, one should expect a secondary reaction after 8 to 10 thin lines, each of which is below the previous. The next we're going to look at is a three-line break. The three-line break is yet another Japanese method of graphic representation using bars. The rules of this method are very simple. 1. If the price does not exceed the previous day's high, or drop below the previous day's low, nothing is drawn. 2. If the price is higher than the previous high, a bar is drawn in white. 3. If the price is lower than the previous low, a bar is drawn in black. 4. After 3 consecutive white bars are drawn, a rule comes into effect, the three-line break. In order to draw a new black bar, the closing price must be below all 3 previous white bars. And 5. After 3 consecutive black bars, it is possible to draw a new white bar only when the price is higher than the 3 previous black bars. Now, a simple trading system derived from the three-line break is as follows. Open a short position after the three-line break rule is effected, and there occurs a black bar. Open a long position after the three-line break, and a subsequent white bar occurs. Now let's look at the Renko chart. The Japanese Renko chart combines the qualities of the three-line break and the Kage. The basic rules for creating a Renko are: 1. All bars have identical size, normally from 1 to 5 points. 2. The size of the bars are specified beforehand. 3. If the closing price surpasses the previous high by the specified size, one new white bar is drawn. Rule 4. If the closing price is lower than the previous low by the specified size, one new black bar is drawn. If the price change is not greater than the specified size, either up or down, no bar is drawn. And finally, if the price change is greater than the specified size, but not enough to make more than one new bar, only one bar is drawn. Now let's look at an example. Let's assume that we want to draw a Renko in which the size of the bars are equal to 2 points. The daily high for XYZ stock on the first day of our chart is equal to 80 points, and we have the following prices for the subsequent 3 days. Now, the closing price for day 2 equals 82 points. It's greater than the previous high by 2 points, therefore we draw one white bar. The closing price for day 3 is 85. It's greater than the previous high of 82 by 3 points. We can draw only one new white bar because a 3-point change isn't enough for 2, which requires a 4-point change. The closing for day 4 is 80. The previous low is 84. Because we have a 4-point difference between the previous low and the new close, we draw 2 black bars. The Renko chart is primarily used for the determination of a change in trend. It's also effective for identifying lines of support and resistance. And a further characteristic is that it discards the minor day-to-day fluctuations, allowing the underlying trend to be more readily identified. Point and figure. The primary feature of the point and figure chart is that it disregards time and cares for price only. This is the way in which a point and figure chart is created. Rule 1. Right from the start, we define a certain box size and then draw only those changes in price which are equal or greater. Rule 2. In each column, we can draw either points for upward price movements as represented by X's, or figures for price drops as represented by O's, but not both. Rule 3. In order to start drawing a new column, there should be a change in price which equals the box size multiplied by the reversal amount. And Rule 4. All fractional changes are rounded down to the next whole number. Let's look at an example. The daily high for day 1 equals 180 points. The box size is equal to 2 points. The reversal amount equals 3 points. Let's assume that we have the following subsequent prices. The closing price for day 2, 185, is greater than the previous high, 180, by 5 points. This is 2.5 times greater than our box size. After rounding the 2.5 down to 2, we draw 2 points, or X's, in our chart. The closing price for day 3, 186, equals the previous high, 186. Therefore, we draw nothing. The closing price for day 4, 180, is less than the previous low, 186, by 6 points. We multiply our box size of 2 by the reversal amount of 3, giving us a total of 6. This 6 equals our price move of 6 points, being enough to start a new column with figures, or O's. Like the Kagi, Renko, and 3-line break charts, point and figure charts attempt to illustrate supply and demand. A column of points symbolizes a victory of bulls over bears, or the prevailing of demand over supply. Conversely, a column of figures belongs to the bears. Just as candlesticks, point and figure charts form steady patterns. Here are some of the basic ones. Double top. This is when a new column of points exceeds the previous one. Triple top, when a new column of points exceeds the 2 previous columns. Double bottom, when a new column of figures falls below the previous column. Triple bottom, when a new column of figures falls below the 2 previous columns. Bullish catapult. This is the combination of the triple and double tops. Bearish catapult is a combination of the triple and double bottoms. And shakeout. After a double top and double bottom occurs. This is considered the moment when the weak traders sell their shares. If there follows 3 new points, this is considered to be a good time to open long positions, in the anticipation of a third top to form. The shakeout ends when the third top ceases. At this point, we've concluded our review of chart types. If any of these charts have seemed overly complex, don't despair. Computer programs used for technical analysis, one of which Metastock will review later, are capable of constructing these charts for us automatically.